2025 is officially in the books, and what a year it was for investors. Between market swings, interest rate changes, and nonstop talk about what's coming next, it was easy to get distracted. But through it all, my simple 3-fund portfolio kept doing what it was built to do: grow steadily and give me peace of mind. In this video, I'm going to walk you through my full 2025 recap, how my 3-fund portfolio performed, what I learned along the way, and what adjustments I'm considering as we head into 2026. Hi, I'm Greg Hardy, and welcome back to the channel, and thank you for being here. We cover all things personal finance, investing, and building a secure financial future. So if you're serious about taking control of your money and also learning something new every week, make sure to subscribe to the channel to like this video. It really helps the channel out and gets this information to more people who need it. Thank you. When I first shared this portfolio, a lot of people thought it was too concentrated and too simple, and maybe it is, but simplicity has been the key to its consistency. I don't spend hours tracking dozens of stocks or trying to time every market dip. I focus on growth, stability, and one sector that I believe will continue leading innovation for years to come. And 2025 proved again that you don't need a complicated strategy to get solid results. A well-structured portfolio, low cost, and a disciplined mindset beat reactionary trading every single time. Let's start with my largest holding, SCHG, the Schwab US Large Cap Growth ETF. This fund still makes up about half of my portfolio, and for good reason. SCHG gives me exposure to some of the biggest and fastest growing companies in the country. Names like Apple, Microsoft, Amazon, and other leaders in tech, healthcare, and consumer services. These are companies that shape how we live and work. The businesses creating the next wave of AI innovation, cloud computing, medical breakthroughs, and digital transformation. In 2025, SCHG ended the year up 17.47%, continuing its strong multi-year run. Growth stocks had a few rough months mid-year, but overall they bounced back as confidence returned to the market. Now, growth stocks can be more volatile, but over the long term, they've historically outperformed value stocks. That's why I'm comfortable keeping half my portfolio here. Another reason that I love SCHG is the cost. The expense ratio is just 0.04%. That means if I have $10,000 invested, I'm only paying $4 a year in fees, practically nothing, and that low cost helps compound returns over time. So for me, SCHG is the growth engine. It's not about chasing the next trend, it's about owning the companies that create them. Next up is my foundation, SPYM, formerly known as SPLG, the Spider Portfolio S&P 500 ETF. If SCHG is the engine, SPYM is the frame that holds everything together. The ETF tracks the S&P 500, which is the 500 largest and most profitable companies in the US, across every major sector, from tech, healthcare, finance, energy, and more. It's my set it and forget it piece. And in 2025, SPYM delivered a steady return of around 17.79%, actually beating SCHG. It wasn't the most exciting performer, but that's not what it's there for. It gives me balance when growth side of the market tends to slow down. And again, the cost is insanely low, 0.02%. That's $2 a year on every $10,000 invested. Over decades, saving on fees like that can add up to tens of thousands of dollars. And also what I love about SPYM is that it represents the American economy. Every time you buy this ETF, you're essentially buying a slice of the 500 most successful companies in the country. It's the backbone of my portfolio, and it's why I've never been tempted to mess with it. Finally, my conviction play, SMH, the VanEck Semiconductor ETF. This fund is all about one thing: chips. The tiny pieces of silicone that power everything we use today, from smartphones, electric vehicles, gaming systems, cloud servers, and now AI. When people talk about the brains behind modern technology, they're talking about semiconductors. That's why I want to own a piece of that future. In 2025, SMH had another strong year, finishing up around 49.17%. The growth of AI and new computing demands kept the chip industry in high demand, and companies like NVIDIA, AMD, and Taiwan Semiconductor continued to lead the charge. But make no mistake, this ETF can be volatile and even make you question your sanity. Some months it feels like it's sprinting uphill, other months it takes a big dip. That's why I only hold about 15% of my portfolio here. It gives me the upside potential without adding too much risk. The expense ratio is a little high at 0.35%, but I see it as worth it for the exposure. For me, SMH is where I get to lean into the future, a focused bet on innovation and progress. One of the biggest advantages of having a simple portfolio is how easy it is to stay disciplined. I only rebalance a few times a year, usually every 3 to 4 months. Now, when I say rebalance, I don't mean I'm out here selling funds all the time. I actually do it in a really simple way through new contributions. So let me explain that. If one fund has gone up and is a little bit overweight, I just buy less of that one for a while and put more money into the others that are lagging behind. Over time, that naturally brings the percentages back to where I need them. For example, this year SMH had a strong mid-year rally. So instead of selling any shares, I just bought more of SPYM and SCHG with my next few contributions until everything evened out again. That's it. No panic selling, no reacting to headlines, no chasing the latest hot stock. Just quiet, consistent adjustments that keep everything balanced. This approach keeps me from making emotional mistakes. Because let's be honest, emotions ruin more investment plans than bad market timing ever will. When you simplify your system, you take the emotion out of it. You stop asking, what should I buy next, and start focusing on what actually works. If I could sum up this past year in one sentence, it would be this: consistency beats complexity. 2025 proved again that successful investing has nothing to do with predicting the next big trend or reacting to every market headline. It's about having a plan, trusting it, and letting time do the heavy lifting. My portfolio didn't change much, but the results kept showing up because I stayed invested, kept costs low, and didn't let short-term noise distract me from the bigger picture. One of the biggest lessons this year reinforced is that time in the market is undefeated. There were so many moments in 2025 where it would have been easy to second guess, whether it was the constant talk of a market correction, the hype around AI stocks, or debates about what the Federal Reserve might do next. But every time I thought about reacting, I reminded myself, the goal isn't to outsmart the market, it's to outlast it. Staying steady ended up working far better than trying to guess every move. Another takeaway was how much peace of mind comes from simplicity. When you only hold a few funds you truly understand, you stop worrying about what's happening day to day. I didn't feel the need to check prices every morning or watch endless market news. Instead, I focused on saving, contributing, and letting compounding work quietly in the background. And that calm mindset is something I wouldn't trade for anything. And finally, 2025 reminded me that the real challenge of investing isn't the market, it's managing our own emotions. Fear, greed, and impatience can destroy even the best strategy. But by keeping things simple and staying consistent, I've built a system that protects me from myself. I don't need to chase the next hot stock or react to every dip because I know the power of sticking with a plan, and that, more than anything, is what keeps me moving forward year after year. As we move deeper into 2026, I'm not planning any major changes. My 3-fund portfolio still does exactly what I want it to do: deliver growth, stability, and broad exposure without unnecessary complexity. After watching it perform across different market conditions, I'm more convinced than ever that simplicity works. I don't need a complicated strategy or constant adjustments, just a clear plan that I can stick with year after year. The only potential tweak I'm considering is a small allocation to a dividend-focused ETF like SCHG or 𝐬𝐝𝐾. This isn't about chasing yield or timing the market, but about gradually building an income component as my portfolio grows. It's not urgent, and I'm taking my time to make sure any addition fits my long-term goals. For now, the foundation stays the same. At the core, my approach for 2026 comes down to consistency. Markets are going to rise and fall. That's inevitable. What matters is staying disciplined, continuing to invest, and ignoring the noise. I've learned that steady contributions and patience do far more for long-term results than trying to outsmart short-term moves. The goal isn't excitement, it's progress. There's one lesson that continues to stand out. It's this: wealth isn't built through complexity, but through clarity and discipline. A simple plan you follow will always outperform a complicated one you abandon. You don't need to predict the next big winner. You just need to stay invested, keep learning, and let time and compounding do the heavy lifting for you. And just as important as returns is peace of mind. A simple, well-structured portfolio removes a lot of emotional decision-making from investing. It helps you stay calm when the headlines are loud, markets are volatile, and opinions are flying in every direction. Instead of reacting, you can rely on a process you've already thought through. And that confidence, knowing why you're invested and how your strategy works, may not show up on a statement, but it's one of the most valuable returns you can have over time. So that's my mindset for 2026. Steady, focused, and confident in the process. Every year is going to bring ups and downs, but when your strategy fits your goals, you can move forward without second guessing every move. And I'd also love to hear from you. What does your portfolio look like right now? Are you keeping things simple or taking a more hands-on approach? Drop your thoughts in the comments, and here's to another year of smart, consistent investing. Now, if you found this video eye-opening, don't keep it to yourself. Share it with someone who you think needs to hear it. And if you want more practical, no-nonsense advice on building wealth and securing your financial future, then check out this video here. And also, please make sure to subscribe. Thank you for watching, and I'll see you in the next one.